the McWhirter theory of stock market forecasting, you would have known by now that we have gone through and taken a look at her secondary factors of forecasting the US markets. However, there was no way for us to really comprehend what McWhirter was talking about at the time. Now, from the original release of this course, there's been a lot of updates, a lot of new discoveries in her work. And I'm now happy to say that we have finally got some form of working model for her theory on her secondary factors in the business curve. Now, we'll take a look at the secondary factors again, and then we'll take a look down further in the book and go over some of the ways that McWhirter would actually do it. And then we're going to apply a more modern spin to this, okay? So the following secondary factors have been found to lift the business curve. We have Jupiter conjunct the North Node, which you know, Saturn trine sextile, semi-sextile Uranus, Jupiter in Gemini or Cancer, Jupiter in conjunction, sextile or trine aspect to Saturn and Uranus, which are an aspect of each other, the North Node in Gemini, favorable aspects to Pluto. All right, so we've already gone through this. We're just recapping again. The following secondary factors have been found to depress the business curve, and that is Saturn conjunct the North Node, square or opposite to it, Saturn conjunct square opposite or semi-square Uranus, Saturn in Gemini, Uranus in Gemini, and we know why Gemini, so go back through the course, you'll know why Gemini is an important one, and also you'll know why Cancer is an important one, so take a squiz through the course again. Uranus square conjunct opposition the North Node, and then unfavorable aspects to Pluto. Now, McWhirter goes on to say, any combination of these factors gives strength for whatever they indicate. That is, being a strength or weakness in the curve. If one or more favorable secondary factors are present, they take the curve upward. If one or more unfavorable secondary factors are present, they turn the curve downward. If one good or one unfavorable secondary factor is also present, the effect of the secondary factors is to neutralize each other or to counteract the effect of the various factors involved. And then she goes on to the New York Stock Exchange and she applies basically everything from the North Node out to the secondary factors on the exchange. Let me see if I can squeeze out a little bit. And the way McWhirter would do it in the past, if we just roll right down here, we've already been through the book, so this is just a recap because we're now going to introduce you to the tool, all right? She would go ahead and pop in the aspect that was occurring and how it actually outlined on the curve itself of the US stock market. So when this aspect came in, when this aspect came in, when this aspect came in, and when this aspect came in. And she'll do that for every single year. And we can see here, she goes through all the aspects, what's occurring in this time frame, and how the market is actually being reflected in that. Now, we don't want to do this the old-fashioned way, right? We want to find a way that we can actually improve on this, because we don't want to be going through an ephemeris, and we don't want to be looking at when these aspects are occurring or when a certain planet is in Gemini or Cancer, because that could take a lot of time, especially when we got to do a lot of data, a lot of different analysis, especially for all this Gann and McWhirter forecasting. So we want to simplify it, right? Well, that's what we have now, 2 new tools. And the first tool I'm going to give you, for those who own Timing Solutions, I'm going to give you the Timing Solutions version of this. And it's all coded out, ready to go. You can just pop it in and get the effect. And also for those who don't have the ability or don't want to or can't for various reasons, by Timing Solutions, I've given you a Google Sheet drive which has this whole method scripted into it, okay? And it's a very lengthy, very in-depth script, and it's actually going to allow you to apply those secondary factors to any particular year that you want, so that you can go ahead and see if the year is going to be positively or negatively impacted at any particular time. So how does this actually work? Well, we have a zero line, which just says that there is either positive or negative aspects occurring, and if there is none, well then this zero line will just be neutral. And then also if there's a positive aspect occurring and a negative aspect occurring, well, it's just going to go down to that neutral line. And that's basically it. So if nothing's occurring or factors are signaling, neutralizing each other, it goes back to negative, but goes back to neutral. And if there's a positive or negative aspect occurring, then we can see that occur in time, okay? So let's go ahead and maybe go back to 1900s and 1910. So what we can see from here is that we have this curve now, right? And this curve is moving from positive to negative, and it is giving us influences in the market, whether they are positive or negative. Now, sometimes the market will overreact one way or another. We've got to remember that this, let's go back to it. Let's go back to it. We've got to remember that the secondary factors are going to push or pull the markets in a particular direction outside of where it would already be going. So if it's going up, if the market is bullish for a particular year and we get negative factors, then it's likely to pull the market down for that time period before the market resumes its primary trend. And then if the market is bearish for a particular year, the vice versa is going to occur, where if we get bullish secondary factors occurring, then it's likely to pull it up for that little time period, and then the trend will resume. We're not saying that this specific curve is all that is guiding the market. This is a secondary factors which have been found to lift the curve and also depress the curve. And it is, I need to be very specific with this, it is the business curve, okay? It is not the stock market curve. It is the business curve. And the stock market is reflective of that business curve. And that's why sometimes we might not get an exact 100% repeat of what happens in the stock market to what can happen in business, but we're forecasting the business curve. And then for us traders or us that are doing market forecasting, we're using that business curve forecast to then forecast what is likely to happen in the stock market, because the stock market should represent businesses as a whole. And this is based on the US stock market, primarily because we're using Gemini and Cancer. If you're doing a localized market, you just want to find out basically the important 10th houses on your market's chart that you're looking at, and we'll move on from there. So let's go in a bit tighter. We'll go 1901 to 1902, and we'll take a look at this wave up higher and then down lower, basically in sync here. Not every single high and low, but the wave in itself is pretty much in sync. If we go to 1902, we can see that, here we go, 1902 to 1903. We can see that we have our zero line, we have business curve likely to be pushed higher, it drips off, pushes higher, and then it falls into the negative territory and all the way down here until the end, and we can see that the actual stock market is also pulled lower during that time, and then it moves higher. But I know what you're thinking, why are we looking out this far? You see, the business curve is pushed higher, the stock market is pushed higher, the business curve is pulled lower, stock market's pulled lower. Nothing happened in this time period here where the business curve pushed higher, however, still below the zero line, so it wasn't positive when this happens. When this happens, just remember that the business curve below zero means that there is negative energy. When it goes to the 0 point, it means that positive energy has come in and it's neutralizing itself, or the negative energy is waning. We could have had either or. I don't have the actual tool up to check what exactly happened here. And then it shot back down again and realigned itself. All right, the business curve shot positive here. The market was coming out of its lows. Yes, we know that the market did fall for this time period, but the market was coming out of its actual lows back here. And then we went above positive. We hodled around above positive here. We can see that the actual stock market is up too. Anyway, this is back in 1900s. We don't want to be focusing on all this. What we want to be doing is going out into the future, because that's, I'm not going to go out any further than 2024, because, you know, we reserve the rights for our members out into 2025. So we'll squeeze this back 2024. All right, so in 2020, we'll do 2018 first, and we'll move on up. 2018 to 2019, again, practical example of what's going on here. We had the business curve above zero, influenced by positive factors. Yes, it's swaying, the market's also swaying. And then we got negative factors coming in out until around December. And then the negative factors are influencing the market. This whole time period right here, the strongest bit is right here. Yes, it can take a little while for the market to react to that. Market storms down from its high, before reversing. 2019. Let's go out to 2019. Look at this wave. 2019 was negative on the secondary factors until the end, but then it goes negative again. So yes, the market did run higher in this time period, but the secondary factors were negative for the year. For 2020, we ran down around to February time period. Big steep drop off here before rushing positive. So we had the COVID crash come in again. Just remember, this is not so much a stock market forecasting tool, but it is more of a business forecasting tool. And then we saw that the positive factors were influencing this, and we can also see this in the stock market. Yes, we had businesses shutting down, but the stock market stormed higher, along with a lot of positive things occurring in business. Ran down to the zero line, but stayed positive this whole time period. So this whole time period is above the positive line. We can't even see the positive. We can't even see that neutral line anymore. Here we see the neutral line kick in. Down here we had some negative factors, boosted up, and then down here went full negative. We had basically an inversion in price here, so we weren't able to follow it directly, but now we're in negative territory for 2022, all the way down into this low before the energy levels move positive again. All right, so now we're moving out to 2023. We see the energy levels push higher. Stock market was actually coming down into lows again before pushing higher. So a little bit of a sink outside there, but again, not so much a direct stock market forecasting tool. We use it in combination with other things. Just showing you how this overlays into the Dow Jones, okay? And then 2024 stayed positive until around April, May. You can also see that the market suffered in this time period too. Shot back up positive, and then I won't go out any further after December, okay? So December still stays positive for the year. We do have a bit of a waning in the energy for the next month and a half to 2 months. However, it does remain positive. It remains above that zero line, and that's what's important. So I would encourage you to go back, just go over the last 100 years or so of data. Let's just pull this out now. Go back over the last 100 years of data, and you'll be able to see exactly what's going on, especially around the time periods of, say, 1987, where we went from positive right down to the negative just as the crash occurred, and then we bounced out of it, and the market trended higher into the positive territory. It's very interesting to see this sync up, not 100% exactly, but it's very interesting to see McWhirter's secondary factors sync up so well with the market. No doubt, it would have worked a lot better in the past just with her charting layout because she charted it a bit differently. We're taking in a lot of different factors that she didn't take in, and we're building it into a program. So she would have had basically the hand touch of being able to do this with her skill, but we're trying to simplify that and get more of an automated system to see if overall we're bullish or bearish for any particular time, years into the future, okay? Anyway, excellent book, and I'm glad that we're able to now offer this to you. And what we'll keep doing is improving on this as we go out, okay? How to forecast trends of individual stocks, etc. We're updating all this for you now with new tools, new methods of doing this, okay? The McWhirter theory method program is available, and you should be going through it multiple times, okay? Just so you can understand. I know it's long, but just keep going through it, okay?